You have long been an advocate of higher rates to head off inflation, which of course we are not seeing. So does that make you feel uncomfortable, like maybe there's something you might be missing?
So firstly, monetary policy is still accommodative. So the gradual path of normalization is really a gradual path. And my argument of why we want to stay on that gradual path is because we are in a more normal economy. Inflation is not yet at 2%, but what we've learned is that we have to move policy a little bit before we get to the goals, or else we're going to be behind or potentially behind. So there's some risk that if we wait too long, we could find ourselves in a bad spot. So again, I wouldn't say I'm an advocate of higher rates. I am an advocate of keeping on this gradual normalization path where we're basically taking away some of the accommodation that we needed to put in for the Great Recession and its aftermath.
And you think, therefore, that the risk of higher inflation is greater than the risk of higher rates having a damping effect on the economy?
Well, there's a number of risks out there, right? So again, I think the underlying momentum of the economy on the real side is very good. We have very strong labor markets, and we've seen that over time. It's not just a one-off report. Steadily improving labor markets. We've also seen that growth has been maintained at a little above 2%. Or so, and I think that's very important because we have had a lot of shocks to this economy, and yet the economy has proven to be pretty resilient. Again, you're right, inflation has not yet gone up to our 2% goal. We've had a couple of weak inflation reports lately, but you can point to some one-off factors in terms of prescription drug plan prices and cell phone data plans. So again, I do expect inflation to remain below 2% over the next couple of months or so and near term, and then eventually rise up to our 2% goal. That's my modal forecast, and I think consistent with that, we want to have accommodation being gradually removed from the economy.
Is there anything that would cause you, any data change that would cause you to change your view that accommodation should be removed?
So one of the key factors in the inflation forecast, of course, is inflation expectations. So far, I think they've been very stable, and that's a very important factor in the inflation forecast.
But your own Cleveland Fed expectations indexes have been moving down the last couple
of
months.
Well, they've moved down, but the kinds of moving down isn't significant. I mean, I would be worried if the low inflation numbers were telling us that aggregate demand was really falling off, and that's the reason prices were coming down, and therefore inflation expectations would be unanchored. I don't see that in the data. I don't project that is what's happening. But that would be the factor that would be significant in my view, that there's a bigger problem and we're not going to be able to make our inflation goal over time.
What do CEOs in your district tell you about their pricing power these days?
So most of the CEOs that I talk to in businesses and even labor market people, they're telling me that they are increasing wages. They are not necessarily increasing prices yet because their margins are still constrained, but in terms of the wage part of the equation, that wages are moving up, and I expect those eventually to feed into the aggregate numbers. We've seen some slow wage growth, relatively slow, but we have seen a pickup. And a very important factor in that wage growth is the productivity growth we've seen, which is quite low. So again, there are some firms that have been able to increase prices which they haven't been able to do for quite a long time, and wages do seem to be moving up, albeit gradually.